Ok. Io am. Ciao.
Ciao. Ciao. So I think we can start.
Ciao.
I think we can start, and I think a couple more people will join us while we are chatting. Yes, you get. So I'm just saying we can start, Marco, and a couple more people will join us while we chat.
So we start now, and then the other people will join us.
Yeah.
But we need to hear it better.
Okay.
Yeah. Okay.
Can you hear us?
Yeah.
Okay, perfect.
Because there are not too many of us, and then it's a very acoustic, so yeah. So hopefully
It's better if the person that speak from you is near to the computer. Otherwise, it's.
it sounds too much. That means so we're now like in medieval times around the fire. So I think that you know all each other right now, yeah? So no need for introduction. I will just, before we go ahead and start, and you have difficulty hearing, right?
Sorry, I heard very, very, very bad.
Yeah, it's probably difficult to hear because it sounds. Hold on. Let's try it now. How about now? Can you hear us now better?
Better.
Much better.
Much better. Okay.
We hear ourselves the same.
Okay.
So I was just saying that, you know, while some people could not show up today because it's raining and it's kind of like, you know, messy outside.
There's a big soccer game as well.
This big soccer game and whatever the reasons they have. I just wanted to give a small introduction to mention a little bit to me, but also to Gaia and to Biljana and to Pavle, and also because we are recording this, right?
Yes.
We are recording this, so just so that others who will be watching, they actually have the update of what's going on from the model that we are discussing for going ahead and investing. So what I was saying to me just a few minutes ago, Guy and I went back to another lawyer yesterday and explained in simple words, as you, Marco, suggested, in simple words of what is exactly that we want to do, right? So we all want to invest together, you know, a total of 250,000 to 5 startups that we're going to select in the second round, and to choose those 5 and invest 50,000 in each of them for 7% of equity. Anyhow, not to go into details of that, the conclusion is the following. Next Wednesday, Vladimir, who's the name of the lawyer, will join us for our mentors meeting to present and to be present to answer any of the questions to the MOU that he will write up. The MOU will basically put in words what we keep saying, that, you know, we are committing ourselves to invest 150 non-monetary terms and 100,000 monetary terms, that we're working towards that, and explaining the following model of how do we do angel investment in Serbia. It's very simple, actually. It's creating a SPV, special purpose vehicle, between us as co-founders of a new entity, a new limited liability company, which we can call Hub Deal 2018, let's say. And then for each of the selected startups in March, when we come to that point, Hub Deal 2018 will be creating a new SPV with the specific startup. So that's the model that will be presented to us more in details next week. So I don't know how is that similar or not similar to models that you know of, Marco. But it seems that in Serbia, because there isn't really that clear legal framework of how do you make angel investments, the simplest model is the best model, basically, you know, in order to protect us as investors and also startups as those who will we invest in, and to be fair on both sides, so they can actually, you know, go ahead and receive the investment, and then we work with them to the next round.
Okay.
Yeah.
Okay. So we talk now about what in Milan, in Impact Hub Milan, we have called club deal. That it's the club deal of a group of business angels that invest a group of a total amount of money in 5 startups that start a period of incubation. So is an investment that it's really seed investment, because is an investment that help the people, help the startups in order to be able to do all the incubation period. Because of course, like Impact Hub, we give to them some knowledge tool, but they need to start with the beta testing of the services of the product, and they need a small amount of money. This kind of money is the kind of money that generally the people call seed or pre-seed money, and generally is coming from or an incubator or from the triple F, so friends, family and friends, and full. No? So this is the stage. So you understand that the stage is a seed stage, is from one side it's a risky business, of course, because it's possible that fail the company, but on the other side, if the company is going very well, of course, the possibility to increase the investment, it's very, very high, because you start in the very first phases. Okay, and of course, is if the startups are selected and started with a program of incubation, is not sure, but it's could for sure better to invest in this company than in a company in the same stage that doesn't perform an incubation period. So the fact that this money is given to a startup that is selected from an incubator, and the incubator invest in terms of not only money, but invest his time and his resources in order to develop the same goal, it's a sort of I don't know, sort of it's not an assurance, but it's something that it's more important for the startups and for the investor in order to invest in these phases. This is the point. The other interesting point in order to do this kind of investment is that the single investor invests in 5 startups in the same moment. So it's very risky in these phases to invest in only one startups, because it's complicated, and it's very risky because there is a lot of possibility to fail. But if you invest in 5 startups, there is more possibility that at least one, that it's the what at the end of the day you want to have, at least one, it's a success story. Because if only one is a success story, you have the possibility to have the return on investment globally. So it's normal that the 20%, 10% or 20% of the company is a success story, only 10 or 20%, and not all the story. What in terms of what the people can do in these phases, the help that the business angel that invest in these phases is it's important that they put on the stage is not only the money, but generally what we ask to the business angel is to be, if they want to be a mentor of the startups, or in any case to help these startups in order to have contact and develop network and whatever. It's what they generally call smart money. So it's not only money, but it's more money linked to a network of people and so on. The point is, from the side of the business angel is, okay, I put this money, I put my network, and when I have the possibility to come back to have a return of investment, and how much, and this is the important story. The possibility to have a return on investment if there is what generally is called an exit from the startups. An exit is a situation when there is the possibility for the investor to sell the company, okay? And in a market like US, it's for the digital company, it's relatively simple that the exit is related to an IPO. So you go to the stock market, and in this moment, all the investor can sell the share, of course. But in other markets, like in Italy or probably in Serbia or in other market, it's not so simple to do an IPO, to go into the stock market. So the possibility for the investor to do an exit is if the company is sell to another company, or it's called generally trade sale. That could be a company in the same sector, could be a competitor, could be, for example, it's what happened in the Italian market with the copycat business. Is for example, if you replicate in Serbia something that it's exists in another market, in US market, when this company want to open in the Serbian market, if there is a startups that are just have a market share and so on, it's more simple for the US startups to buy the Serbian startups and not to build up a new startups. So it's happened very common in the copycat business that you do this kind of business. And this, for example, is exactly the model that Rocket Internet start in the past. So they start in German, and they look all the business that work very well in US, and they say, okay, we can do the same business in Asia, for example, with online market, or in Europe with online shopping and whatever. And they focalize on this, and they replicate very, very well the same business, but replicate really the same procedure if it's possible. Because in this case, when the US company look on the European market or the Asian market, see a company that have the same procedure, same model, same business, and they say, okay, I buy this company, I change the brand, it's the same for the client, it's perfect, okay? And of course, this is very successful. They do a lot of time. and it's a perfect model. Generally speaking, this is what the business angel could expect. So to invest now and to exit from the company, to sell the company in a time frame that is normally is between 6 and 7 years. So it's a patient investment. So it's not a rush investment. So I buy now and I sell in 1 month or in 3 months or 1 year or 2 years. Could be possible. It's happened. It's what they call early exit, but it's not so easy. It's happened sometimes to do an early exit. If you work on the normal exit, the expectation is that you look on a business that in 5 years, 6 years, or 7 years, this company, the value of this company is 10 times more. If you look on an early exit, it's normally 2 or 3 times more from the initial investment. So of course it's different. It's possible that you follow the investment. So some business angel that invest in the seed phases invest in the second phases that it's called early stage. What is important to say is that like a business angel, you need to have a very clear strategy, and consider that the strategy of a business angel, it's really a statistic business game. Is not an entrepreneurial game. So you are not you need to know to I would say it's important that you don't love a specific business and you invest only in one business. Okay, it's really important that you diversify in several startups, 10 or more startups. This is the really important things. And you play a statistical game. So if you invest in 10 startups, there is 10% of possibility that one is a success, is a unicorn, and these startups do 10 times return on investment. So your business games play, otherwise doesn't play. So if you invest in 5 now with the club deal, and then you follow up only in one, a lot of money, consider that this money play another game. It's not the same game. It's another allocation of business, of investment. Okay. For example, what I have like a rule in my that I did never do a follow-up. Never. I never did a follow-up. So I invest only in one round, the same amount of money for each startups, like a business angel. And like an incubator, the same. So we invest in the seed phases, and we invest the same amount of money in each company. Okay. This is the main rules. Some question or specific question?
So from the angle of investor, during this period of 6 to 7 years, are they seeing some kind of annual, let's say, the return, like annual, my brain froze, how it's called, some kind of return, annual return on their money from the profit or something like that, or is it they're waiting only for the final exit?
Okay, on average, in the market that are more developed on this stage, that have a story, the return on investment, the IRR, that it's an annual return on investment for a business angel is on average 28%. So it's very high, okay? Of course, it's an average. So there is someone that have 100% and some other nothing, of course.
That's
but on
6 years, right?
Sorry?
After 6 years, right?
Yes, after 6 years, it's they calculate the portfolio of a business angel. The portfolio of a business angel have this on average this internal rate of return, IRR. The point is that the possibility to catch this IRR, it's more higher depending on how many investment you do. Okay, so the possibility, it's you have the possibility to catch this percentage at 80%, so it's very useful if you do at least 20 investment.
Wow.
If you go on 10 investment, is down at 50%, the possibility to catch the 28%. So it's really a statistical business, okay?
Right.
So you need to have in mind that you have, I don't know, 100 to allocate. You want to allocate this 100 and you want to do at least 10 startups, okay? You have a maximum ticket of 10 for each startups. Or if you want to invest in 20 startups, you have a maximum ticket of 5 for each startups, okay? You define this at the start, and then you perform really in the same way. Really, I have a ticket of 10. I have invest only 10. Only in 2 cases, I have in one case 8, and in one case 15. So it's very, I move really little from my point. Okay.
And do they get some kind of profit share after each year, or no? They're waiting for only for.
No, generally speaking, you look on a sell company, so an exit from the company, right? Because what you the game, it's work on the valuation of the company. So the company, you invest in a company that now the valuation is I don't know, 1 million, and you want to have an exit when the company is 10 million, okay, or more. It's really almost irrelevant if the company did money or not. But the point is, the valuation of the company is 10 times more. So because if you look only on the share, on the profit and and you pretend to have money from the profit, you didn't come back from the investment.
Right. And then the investors, they can exit earlier before this 6 year, only if they sell their share, right? Is that the only way they exit, right?
Sorry?
If an investor would like to exit before 6th or 7th year, they can do that, right?
If it's possible, yes.
And then they evaluate the share value at the moment, how they sell it to, because the company is not on the market, I guess, and they just sell it to somebody within, or I mean, I'm just asking, if I'm talking to some investors, I would like to have all the possible answers to their questions. So I'm thinking of some questions that they might ask. You know, what happens if they want to exit early?
But the point is, you can exit early if there is a possibility. Of course, in some cases, it's better to have less money before than a lot of money for in the future, but could be is not sure. the point of the valuation is it's really, in reality, it's really a mess, because in reality you don't have in a startup phases, and until you have 5 years of story or something like this on the market, it's really difficult to use a normal evaluation method in order to evaluate the company, okay? Because you don't have the story, you don't have the money. So the point is that this game, the business game of the venture capital, is a game where the valuation of the company is based on the expectation on the possibility. So I invest in this company, and I put in this I say this company is 1 million of valuation only if I think that in 5 years this company, the valuation is 10 times more. Yeah. So in reality, it's something that it's go on the other side. So the expectation is in 5 years this company is a company that do I don't know, 100 million of revenue with this EBITDA, and in this kind of market, and a company like this in the market, actually the valuation is 10 million. Okay, the company now, the valuation is 1 million.
Yeah, but let's say we're talking about the specific case here with 5 startups in one bucket, right? So investor comes in, puts 10,000 in this bucket with other investors, and then waits a few years, and then is there some kind of and then let's see that two of the startups are doing well. Let's say the others maybe went down or didn't show that they're gonna grow. So we have only 2 moving forward, or 3 or 1, whatever. So then at what point actually investors exit? Is there some kind of specific time then they say, okay, now we can exit, or how it's done usually?
No, it's based on opportunity. When you have the opportunity to do an exit, you need to do an exit.
So do investors exit at the same time?
Sorry?
Do all of the investors exit at the same time?
Generally speaking, yes. In reality, in a market like US, that it's a market very developed, very mature, there is a situation where there is a venture capital in different stages. So they call seed round, early stage round, and then they have round A, round B, round C, and so on. And there is venture capital that invests only, for example, in round B. This kind of venture capital, it's a venture capital that work for more like a private equity funds and not like a venture capital. And generally could be happen that they decide to invest money in the company and buy from previous investor, in order to have all the rights on the company and to have the cap table very clean. So right. They say, okay, you all the business angel go out and I buy all this share for this money. If this happened, generally it's a good opportunity for the business angel. And on the other side, generally, even if it's not a real great opportunity because you think that this is a new Facebook and you prefer to stay on the cap table, generally you don't have a possibility to stay. So, but this happened in US, and I never see something like similar in the Italian market, or generally in the European market.
But what is the usual practice in this type of investments?
Sorry?
What is the usual practice in this type of investment, like an Impact Hub deal?
The usual is that we The exit is together with all the other investors. So after 6 years, I see in reality, like Impact Hub Milano, we don't have story of exit at the moment because we start 2 years ago. But like Business Angel or like other incubator here in Italy, the only exit that there is exit. It's a sell off all the company. So all the investor and the entrepreneur sell the company and enter other people. Generally, it's trade sale.
So they received an offer, or Impact Hub went out and then offered the company to somebody?
You need to do. It's happened that came some offer from the outside, but you need to be proactive, yes. And in some cases, like a business angel, when I manage the group of business angel, we manage actively this, really proactively. So in some cases, we work together and we pay M&A bank in order to sell the company.
Okay, so that would be, let's say, a part of Impact Hub's part of the deal, or?
In reality, it's not really part of the deal of Impact Hub because Impact Hub is proactively in order to find other investor that is necessary in order to do the second stage. So other group of business angel, venture capital, and so on. And generally, is this kind of venture capital that work really actively in order to sell the company and to sell your investment too, so your share.
Okay.
So you need to work in proactively when there is the second round, no? In order to find a company, or sorry, an investor, a venture capital or whatever, and when you find them, you need to align your goal with the goal of this investor. If you have this alignment, you don't have any problem because he do his work and he try to sell the company after 2 years and whatever.
So can we tell to investors that once they get in with their investment into this 5 Impact Hub deal of 5 startups, then after 6 or 7 years, we will work together on finding another buyer, which will give them a possibility to exit. So in a sense that this investor understands that they're not just left there with their investment without possibility to sell it, or actually, not knowing what to do. So they get some kind of additional bonus from working with Impact Hub in that sense, right? We can tell them actually that they have some.
Sorry, I didn't follow you.
Yeah, sorry, I was I expanded too much. I wanted to say, so when I'm talking to investor, I just want to tell them, possibilities, what they can expect and everything. So, and I'm having in mind some people who might not have invested previously in other companies, so new investors, let's say. And then when telling them, okay, so you put your money here, and then there are 5 startups, you lower your risk with this. We work together on helping these companies grow. They go through acceleration. It's all bonuses for these investors, right? They don't know what to do usually, so we give them this bonus. And then let's say we watch them grow, and then some of the startups, they reach after 6 years a good value. And then we, as Impact Hub, we help investors find a buyer. So my question is, can we tell to investor that this is one of the activities that we will do as well to help them, so they can understand that they're not alone at the end of the road?
Okay, so what it's possible to say, but in reality, it's not real, because you invest in the first phases, and you are the investor responsible in order to find other investment after your investment. So it's something like we can say le staffette. We can say staffetta.
I don't know what it's called. Staffetta.
We say the same.
Okay, okay. It's like this. So there is one runner, one investor that bring the startup from point A to point B, and then there is another one that bring from point B and to the point C. So what is your job, like investor, like incubator, is to help them in order to build up the company and to find the new investor, okay, the new runner, and this runner help the company in order to find other investor, and the other one generally help them in order to sell the company, because the point is that they have access at the market, at the correct market in order to sell the company. You don't have the access.
Who does?
The B one.
The B ones. The next one.
Right.
The B one, because they invest in company that they have in portfolio some company that could be by the other one.
I'm trying to see from the angle of the new investor, of the angel investor, let's say.
Yeah.
I'm an angel investor and I don't have previous experience. I don't know how to do exit, right? I just want to see my money increase after 5, 6, 7 years, right? So I say, okay, I'll give you 10,000, right? And then what then? I'll let you do the work to grow this company. When I see my money back, what I need to do? So what I tell to this type of investors? I mean, what I tell them?
Okay, the point is this one. It's like if you take a train, you don't drive the train, but you have the same goal of the people that stay on the train.
Right.
So it's not, if you are aligned with all the other investor and with the entrepreneur, the exit is very clear. So the point is, when you start and when you invest in the company, the important thing is to align the goal with the entrepreneur. That, hey guys, in 5 years, your company is not anymore your company. There is 90% of the possibility that your company is sold to other company and you start another job, another company and whatever, okay? This is the first point. After this, you need to align with the other investor. Okay, guys, you enter in my company, in the company that I invested in. You enter only if you are the same goal. So the goal is to bring this company and to bring this company from point B to point C. And in point C, you sell the company. If you are aligned, you don't need to think how to sell, because they sell for you.
Who sells?
The B's.
The other venture capital, the other investor.
Who leads this exit? Who is the person? Who is the entity in charge of leading this exit?
The venture capital funds.
Who finds them? Who leads
The next round.
So in
how do you get to the
Impact Hub, we had to have clear, who is the next round. If it's Jan from South Central, it's just an
right,
example.
so Impact Hub leads and defines the next round.
And we take them and we actually ask them to
right, so
sit with
Impact
us.
Hub is the leader of the exit from the first round. From the exit.
It's not an exit.
It's not exit, but
Find the next investor.
finds the next investor
Yes.
who will then start this
Yes.
exit for the first investors.
No,
Then find the next one.
there is.
Right, but
Yeah.
I'm just saying, okay, so we reached a certain point of company development, I as an investor, right? And then I'm waiting for something to happen.
Yeah.
Who initiates this change, this next step? Who initiates it?
in both business
So
angels started, so
I'm
they
business
didn't-
angel. What I need to do to move to the next step?
So
Is it Impact Hub who does something, or I as investor do something?
no, it's Impact Hub, but we discuss it together, right? So that's part of the exit strategy.
Right. So
when
after
we see
5 years,
it-
Impact Hub comes and say, okay, now we move to the next stage. We're ready to move to the next stage.
after 5 to
6, 7,
6 years,
yeah.
we say we exit,
Okay.
right? That's-
So you
yeah.
lead this next step, right? You as an Impact Hub in
So-
front of the.
We lead in terms of the fact that we are presented at that point with the opportunity to exit.
That's my point. Yes. So you find this opportunity, or you present this opportunity, or talk about this.
But we're not driving the bus at the next stage. So
No, not about that.
So
Not about the next
Ian
stage.
from
Yeah.
South Central
I'm just talking about the change, this first change, the first step.
The first thing is Impact Hub.
Yes.
So we invest 50,000,
Yes.
and we find another one who's going to invest, let's say, 250.
That's my question. So I, as an investor, I say, okay, I tell them, okay, you invest 10,000 now.
Yeah.
Then after 5, 6, 7 years, Impact Hub will work to find next.
No, it's sooner. It's sooner than
It's
that.
sooner.
Sooner than that. Because in 5 years, you want to sell it for 2
Yeah.
million.
If
Because usually the life cycle is that we make a 50K investment now. Probably depending on the burnout ratio, it can last between 9 months to a year. Mark, what's your experience in that? How much they can run in the money we give them in this size? It's
Sorry?
how long can a business run when they receive, let's say, 50K investment? They're like 9 months to 15 months of burnout ratio, something like that.
Yes.
So probably they need a next
1 year.
Yeah, 1 year. So they need the next investment in a year and a half max.
Yes.
hopefully even earlier.
250, 500K.
All right. So these the first investors are still in the company.
Yeah.
Right? When this
Yeah.
Yes. They
All right.
All the time.
That's fine.
I give you an example.
Think about how to find the next one, right? They don't think about it. It's not their job. If it happens, okay, they found it. But if
Yeah, it's not. It's Impact
It's
Hub.
Impact Hub.
that's okay,
Yes.
that's the answer. Okay,
Yes.
so now we pass this.
You see my screen?
Yes.
Okay. This is a cap table of a startups. Okay. This is all the investor. The B column is all the investor. This is a second round or third round. This is a new investor. Okay. The blue one is the new investor. This guy, first investor, is the guy that now manage the company, manage the investor side of the company for the future. Until now, we manage for them. But before them, before us, we are,
I see.
we are Musicalia, okay? Musicalia, it's the vehicle of the business angel that enter in a second round. And we manage this round of new investor. So we found the new investor. Before us, there was this guy, M31, there was the incubator originally. Okay, the other are small investor and whatever. So there is entrepreneur and small investor. But in the first phases, there is the incubator. The incubator find the Musicalia, that is a group of business angel, and Musicalia now find all the other investor. And now this kind of investor, particularly this one, LSG Venture, help us in order to find other investor or to find the exit.
So
Okay.
they take the lead.
Sorry?
They take the lead.
Yes. In terms of investment, yes.
Right. So then after we reach 5, 6, 7 years, and when the first investors need to get out, it's already happening through some other investors that are already. Okay, so
yes.
Yeah.
There's investment.
what we can say to these first round investors, we can tell them, okay, you just invest the money, and then the things happen, automatically after that, Automatically. You just give us the money.
We'll tell you.
We'll tell you when you go to collect. Okay,
Yeah.
okay, I understand. on the side, but yeah.
Now, Marco, there is also practice that we hear that alternatively, you don't wait for the exit or the sales of the whole company, but you as a first investor, as an early stage investor, can collect your return if a certain transaction happens in, let's say, whenever, year 3 or 4. In other words, you do kind of like you as a minor investor, you have the majority right of making a decision whether you want to sell this company or not, or whether you want to pull out and devaluate this company in another way or not. Is that something that you know of?
But you talk about the drag along option.
Yes.
Okay. The drag along option is an option that you have like an investor, and generally the new investor asks for the same right. The drag along means this one. Even if you have only 5% of the company, due to the fact that you put money in the company and you have money back only if you sell the company, you need to have the possibility to sell all the company, because the people doesn't buy 5%, but they want to buy a company. So 100% of the company generally, or the majority of the company. Due to the fact that you have only 5%, you need to have a right that is called drag along, that you are able to sell all the company, even if you have only 5%. So I have the 5% of the company, and you ask for the company, and you say to me, okay, I'd like to buy your company. Okay, I can buy. I buy my 5% plus 95%. And that people are not able to say, I don't want to sell.
But is there a limit on the value, like a bottom line?
You can put a, it's your choice. It's possible to put a minimum floor, right, what they call floor. For example, in my company, I put a floor. I give to the new investor in Impact Hub the possibility to sell all the company, but there is a floor. It's a floor that guarantee me that if you sell the company, I can buy at Bahamas for some months.
Right.
Okay.
Okay.
This is you can put on the contract with the company, and generally the new investor asks for the same rights. Or if you don't have, generally they ask for this right, and if they ask and you don't have, you can align with them, so you have the same right, or you sell before my company, because you understand there is every time there is a new investor, the new investor put his contract on the table, and you discuss all the clause of the rights of the contract, no? And what is important for you, like as investor, is to be aligned with them, and not aligned with the entrepreneur. Okay, so to have the same right of the new investor. In this case, if you have the same right of the new investor, when he sells the company, you sell the company together. Okay. Then, of course, the drag along possibility, the drag along rights, is something that it's not possible for the entrepreneur to stop, but they have the I don't know the English name, but it's prelazione, so the possibility to buy your share at the same price.
Pre-notion.
But for you it's perfect, because it's not necessary to sell all the company. You need to what is important for you is to sell your share. this is the prelation is something that is normal right in every country. So I suppose there is the same in Serbia.
That was my question. Is there such an option? Because we asked him yesterday and he said it's possible, but I don't know what it's called.
Okay. And other important rights that normally you put on the contract, it's the liquidation preference. The liquidation preference is a guarantee from investor side. The clause is this one. Then, if something happened that you need to liquidate the company, so the company doesn't work very well and whatever, and you say, okay, we stop to work, all the money give back before to the investor until the investment, until the amount of the investment, okay? And if something remain, we share based on the shares, okay? In this way you can guarantee your money, because suppose you put 1 million in the company, and after 3 months you discover that it's impossible to do the product because there is an infringement of patent, or there is no anymore the market or whatever, and the company spend only 300,000 euro. If you don't have the liquidation preference, you lose almost all the money because you have only 5%. So of 700 euro, you have only back the 5%. With the liquidation preference, you have all the money back. What is remain on the company?
Right.
Okay. So it's really important to have the liquidation preference. In some cases, there is some venture capital that put the liquidation preference with a multiple. So they put liquidation preference at 1.1 or 1.2 or 2. So they need to have money back for 2 times, and then there is the time. But it's not so fair. The fair valuation is 1. Liquidation preference 1. So I have the money back.
Marco, do you have in terms and in your contracts those things referring to like golden vote and more like strategic direction of the company and stuff like that? Because obviously they will pivot in the first year or 2 to actually get a product market fit, but meaning that if shareholders, if we call them like that, see that company is not going in so good direction, do we have a mechanism to actually stop that suicidal moment of the company founders?
Okay, you can put this a lot of rights on this on this matter. I did this like Impact Hub. We did a choice to be very lean, so we didn't have this kind of right, because in reality, when during the incubation period, in reality there is no problem of board or representation of the board or strategy or whatever, because we discuss about strategy every day, okay, every week. So in reality, they start the incubation program because they think we can give to us, give to them some value added. So they ask for advisor or for whatever. Okay, so during the incubation program is not necessary. After them, generally the new investor ask for this right, and they bring in any case this right. So, for example, if there is a person on a board, board member, if you ask for a board member, but after 6 months they need to receive a new investor, and the new investor asks for the board member, you go out for the board. So it's a sort of lose of time for an incubator, but you can do it. And for sure it's necessary if you are the second investor, if you are not the incubator and you are the investor, where we are where we invest like a group of business angel. We ask for all this right. We ask for a board member. We ask for we have the veto decision for some rights, for some strategic decision. So the entrepreneur cannot invest more money respect what is right on the budget. They cannot invest in consultancy. They cannot grow up in the salary and so on, even if there is not the okay from the investor side. And you can have a lot of I can send to you, but for sure your lawyer have the same. You have a lot of bullet point of single specific voice of right that you can put on the table.
Cool, thank you.
Other question or doubts? Fog.
Is Bob still there? Is Bob still there?
I'm still here. But I have to go actually right now. I was just writing a chat, but thank you, Marco. This has been really helpful and has clarified a few things for me. So thank you. And head off. So I'm sure I'll see you all very soon.
Okay.
Okay. Thank you.
Ciao.
Thank you.
Good.
So clear.
Yeah, so
Okay.
so far.
Okay. So far.
Okay. We can conclude then for today.
Yeah.
No other question? It's all clear? Really?
Clear.
Really?
Right.
Thank you, Marco.
Nothing. And I can send to you some example of the right that we discussed before. So board member and the right of the board member, right of the investor on this side. And the main clause of the main point of the drag along. There is another that is called tag along, but it's very similar. And liquidation preference or whatever.
Super. That helps.
Okay. Okay, great.
I'm sure we'll have more questions as we go along. So we'll talk anyway.
Okay.
Thank you.
Don't worry.
Thank you, Marco.
Great. Thank you to you.
Grazie.
See you.
See you. Bye bye.
Ciao, ciao.
Bye. Bye bye.
Clear.